Just a reminder that this content is for education and entertainment purposes. All content in this presentation is of general comment only, which does not take into account your current personal or financial circumstances and is not advice. Please seek advice from a qualified and trusted financial advisor before acting upon any of the information in this presentation. Hi everyone, I'm Jace Pettinese, partner at Cutcher Neale. I'd like to introduce you to our new webinar and podcast series called Cutcher Neale Insights. This series will be available on demand. You'll be able to watch it and listen to it both as a webinar and as a podcast. We hope you enjoy the experience. Thank you. Welcome to a Cutcher Neale Insight. Today we're going to focus on the residential property market. The presentation is going to go for about half an hour. We're going to focus on a couple of key factors. Number one, why residential property? We're going to then cover off what's driving this rise in the residential property prices. A key one, structuring, both on a tax and a loan point of view. And importantly, we're going to get some update from some experts. We're going to cover off on Sydney, Newcastle and the Brisbane markets. And finally, just some takeaway points to consider. So why invest in residential property? It remains a fantastic long-term wealth creation tool. You get a passive income stream. Comparing it to current returns on term deposits, yields about 3 to 5%, it's a pretty good return. Negative gearing tax benefits still remain, a great outcome for some. And for others, it's a diversification of assets, getting away from listed shares or cash. But for others, there's non-financial factors to consider. For some, it's the comfort of bricks and mortar that they can't go past. For others, accommodation while the kids are at uni, something for them to live in while they're there. There's also some that are thinking long term, somewhere for them to live in the future. And that's an important factor when we think about the structuring of both the loan and the tax structure going forward. So what's driving this price increase? Of course, low interest rates. Debt is cheap. It's driving many people to invest. And as I mentioned before, term deposits, all-time low returns when it comes to cash. That's pushing some into the property market. For others, it's a bit of a COVID impact. People are moving away from capital cities into regional areas. You think about the working from home and the use of technology, you no longer need to be in the capital cities, and working from home even a couple of days a week is making a massive change. For others, it's FOMO, the fear of missing out, impulse buying. It adds to people pushing up prices. And that all leads you to think, is this a boom or is it a bust? Is it sustainable? Listening to the Housing Industry Association and also some ComSec economists, they're all saying that it's not so much of a boom that's going to bust, but it is sustainable. We may get some dips in certain regions, but they feel that the market is fairly priced. So if we're thinking about buying a residential property, who should be the owner? There's lots of things to consider. One key concept remains, at risk and at wealth. We always need to give this serious consideration. We don't want to put your hard-earned money at risk from creditors or anything else. You'll see there we've got some key structures that we've got a barbed wire fence around. Self-managed super funds, family trusts, and even investment companies. These need to be given some serious consideration. You'll see on screen a slide which shows lots of different options when it comes to residential investment property structuring. There is no one size fits all. It always depends on your own personal situation. For example, do you have capital losses? Where do you have cash? How can you access the cash? Company investment vehicles are now becoming attractive, even though they can't get the CGT 50% discount. So we've got to keep this all in mind when we're thinking, what is the right structure for you? We touched on before the idea of self-managed super funds. It remains a fantastic strategy for buying residential property. There are more complexities, but with that comes lots of benefits. A key one being approximately 60% more cash to reduce debt. I've got an example there on the screen, which you can have a look through. On top of that, more debt just from the net rent that you receive, you can also add to that your personal and employer super contributions to further reduce debt. We've seen examples of people buying residential properties in their own self-managed super fund with a 1/3 deposit, and with the combination of rent and personal superannuation contributions, they've been able to repay the property within 8 years, a fantastic result. Let's move on to loan structuring. It is critical that we get this right the first time. We often see people rushing in and just getting the cheapest rate on a loan. It's not always the right answer. Split loans are problematic. We want to make sure we've got a nice clean loan attached to the property. We've then got to weigh up the key variables: fixed, interest only, principal and interest, which to choose. It's going to come down to your own personal situation, but we do need to think long term. Offset accounts are a key important consideration. For example, if you're living in a property now that you're looking to move out of in the future and want to make it a rental property in the future, repaying the debt now means that interest deductibility is lost. You cannot redraw on that loan in the future to claim the interest against that property. If we have an offset account in place, reducing the interest, we maintain the debt and we maintain the interest deductibility on the loan in the future. But we need to think about this up front. Another key consideration is good debt versus bad debt, and that is deductible versus non-deductible debt. Let's try and reduce the non-deductible debt first, and that can come down to your loan structuring. And finally, something else to consider. With the prices of property going through the roof, it's common that we're using the bank of mum and dad to help the kids get into the property market. Now, typically that means we're handing some cash over to the kids to use as a deposit or to take away a large chunk of the debt. That capital that you provide to your kids is now at risk from a family law claim on a breakdown of a family relationship. So we need to consider this and look at what we can do. And we can treat mum and dad like a bank and put in a registered mortgage and take security. That takes the risk away of you losing your capital that you've now given to the kids. Okay, now it's time for an update from the experts. We've got 3 experts today. From Sydney, we've got Ben Weeding. From Queensland, Tyson Clark. And from Newcastle, Kylie Friesen. They're each going to go through their views on what the property markets are like in their local areas.
All right, hello everybody. My name is Ben Weeding. I'm a buyer's agent and property strategist at LGen Property, and here to give you a Sydney property market overview today. Before I start getting into the market though, I want to sort of address a question I get asked a lot, and that is now a good time to buy? And when I get this question, I know the asker doesn't really have the right mindset to actually invest in property. They're thinking very short term. They're not thinking about creating wealth through investment property. Property should be a tool that's used to help create wealth. Wealth doesn't get created in a day or a week. It gets created over the long term. So the question shouldn't be, is now a good time to buy? It should be, what is the cost if I don't act now? So here we've got a lady, Diana. At the age of 20, Diana, she purchased a property for $500,000. And over the course of the investment of her life, this property doubles in value every 10 years. Now, you might look at this and think, oh, well, the opportunity cost of me not buying a property, or Diana buying a property at age 20 and she waits till she's 30 is maybe $500,000. But I challenge you to think differently, and that the opportunity cost of her not investing at the age of 20 is actually the last 10 years of that investment, not the first 10 years, because that's the growth that she doesn't get to see in that asset over the course of that lifetime. Let me show you another way. We've got a gentleman by the name of Clark here at the age of 21. He decides that he's going to invest $2,500 a year into a deposit or investment. And he does that every year for the next 10 years, and then he stops saving until he's 70 years old. Bruce, on the other hand, at the age of 31, does a similar thing. He invests or deposits $2,500 a year, but he does that every year until he's 70 years old. He doesn't stop like Clark did. Now, say that these investments are at about 7% per annum, which funnily enough is the average growth rate of Sydney property since World War II. You might be surprised to know that Clark is the one who has the most money at the end of the term of this holding of this asset. Now, why does that happen? It's because at the same age that Bruce started investing, Clark's investment is at a much higher capital base than Bruce's, and thus the compounding effect of owning that asset at that time earlier does the work for him. So remember, property is a wealth creation tool, and time and compounding will actually do the heavy lifting for you. So let's get into the Sydney market. Why is the market running so hot at the moment? The Sydney property market is very much based on macroeconomic events, and those changes are really what have influenced the market in a very short space of time recently. I'd probably put it down to three main things that have been the driver. The first is interest rate cuts. In a post-lockdown world, we've seen the Reserve Bank slash its cash rate to 0.1%, and that's bailed out droves of borrowers by driving down variable rate home loan costs. The banks have obviously given some repayment holidays as well. And I would suggest to you that if you haven't reviewed your loan on your property in the last 12 months, it may be wise to reach out to Dean Menzies and his team just to get a look and see if they can cut costs on your loan a little bit more. The second thing that's really been an influence has been the Reserve Bank's term funding facility. Now, that's given lenders, banks, finance companies access to about $180 billion worth of cheap money at a price of just 0.01%. And that's in turn allowed banks to offer current and prospective homeowners the cheapest fixed rate mortgages in history. And lastly, we've seen some really good fiscal stimulus come through in the form of JobKeeper payments and also boosts to the construction and renovation market as well, which have been a big driver. You combine all this together, and that's really given consumers a boost in confidence. It's been categorically the number one reason to create the velocity and short-term boost to property prices that we have seen. In the Westpac Melbourne Institute Survey Index every month, they ask the question, what are your expectations for house prices? And you can see here on this chart that in August last year, we were pretty much at 10-year lows in this index. But in the space of less than 6 months, we've gone to 10-year highs. And that really emphasises how quickly I think we've turned around because of that extra confidence in the marketplace. But it's been home owners and owner occupiers that have really driven market demand with this increased confidence. The investor is only starting to get a smaller appetite and certainly less of an influence than we'd seen back from between 2014 to 2017. So COVID lockdowns have had the opportunity for these owner occupiers to search for larger homes and better lifestyles. And that's been the big driver of this shift to houses. You can see markets like the Central Coast, the Upper North Shore, the Blue Mountains and the Northern Beaches have really seen good growth because of the search for larger blocks of land and the opportunity for a better lifestyle, where units on the right-hand side here have suffered in price growth. And a lot of that too has come because of rentals in these dwelling types have been impacted significantly due to COVID by around 15 to 20%, especially in areas of high density and importantly, more transient type of tenants. So areas like the Northern Beaches have had little movement in rent. That's because there's not a lot of movement between tenants, people coming and going to the area, where places close to the city, such as the eastern suburbs, Surrey Hills, the inner west, they tend to get students, travellers coming in and going. And obviously that's not been as much of a prevalent part of the market anymore. From a supply-demand perspective, which is obviously an influence on pricing, we've seen new listings that have come available to purchase have been okay. There hasn't been too much deviation from the seasonality that we've seen over the last 5 years. But prices are moving really, and here's this chart again, because there's just so many buyers out there in the marketplace and not enough product to satisfy the particular demand for them. So where do we go from here? So bearing in mind the first part of this presentation was on time and compounding being your friend as an investor. Now, I don't have a crystal ball, but the question is obviously, has this market run too hard and too fast? Or are we going to see more upward movement in price growth? So I think it's important to address the concerns in the market or the risks that are around for any downside. And I think any concern around mass delinquencies probably should be dismissed. The bank's home deferral program is basically non-existent now. Everyone is pretty much back paying off their mortgages as per normal. It did serve a purpose at the time, but that certainly eliminates any types of forced selling in the market. The end of JobKeeper has been a concern as well, which we saw at the end of last month. There's been expectations, or there is expectations, of 100,000 job losses because of this. But honestly, this may well be a blip on the radar. There's massive amounts of job vacancies and employment is exploding in the last couple of months. So much so, the trajectory of a return to only 5% unemployment is likely going to be achieved by the end of this year, which is phenomenal, really. For those looking at this chart, this is a reversed unemployment chart. So you see as the blue line goes up on the right-hand side, that's a fall in unemployment. On the demand supply side, building approvals for houses are actually rising. So there's more housing stock that potentially is going to come to market with the incentives from the New South Wales government that are on the table. But there's only really so many houses that you can build in a year. And it's more the attached dwellings or unit market that we like to look at. And that remains pretty subdued, obviously, with the lower demand for this type of asset at the moment and with immigration and travel being stalled. When we do return to more free-flowing borders, though, we may well end up seeing a shortage of stock in this space, which is important. So the Reserve Bank has similarly flagged repeatedly in several meetings since the end of the year that they envisage rates to remain low for some time. But additionally, any macro-prudential measures like the tightening of housing credit that we saw back in 2017-18 from APRA may not even eventuate in the near term as well. There's little on the horizon for the Reserve Bank to be concerned about. We've got low delinquencies, falling unemployment, and actually the need for free flow of credit and increased confidence in the marketplace is required to get the country back on track post-lockdowns. So all in all, there are more positives than negatives at this stage. There are always good opportunities in the marketplace, and that's what we do, as long with the other speakers who you're hearing here today in their specific areas, finding great investment properties for clients. And we do this by identifying the right area, finding the right property, and negotiating the right price. I want to leave you with this number just to finish it up. It's 15 months. This is the amount of time that Domain has said takes a buyer of a property to go from deciding that they are going to buy one to actually buying one. And as we've spoken about, there's an opportunity cost in delaying this, and making this happen more quickly is to your advantage. So if you would like assistance with helping you to accelerate this, then obviously reach out to your Cutcher Neale team. And if you'd like to talk to me, here is my details. Thank you very much for your time today.
Well, thanks very much. My name's Tyson Clark. I'm with Sotheby's International Realty here in Brisbane. So we specialise in the Brisbane property market and Southeast Queensland market here. So prices are on the rise, and what I might say is hesitation is at an all-time low. So many people are going to look at a property because of the low supply. They're making offers after the first inspection so they don't miss out. So you've got a lot of buyers coming in straight away. They're putting offers on the table. They're good offers, and they're basically moving forward without hesitation. In the past, you may see people come back 2, 3 or 4 times before they then decide this is the house for them. So hesitation has been significantly removed. That's driven by an increase in competition. So like I said a little bit earlier, they're massively due to low supply and high demand. So the demand is outstripping the supply by far. I have never seen a situation like what we are currently in Brisbane, where there has been such a limited supply of property. Typically for myself, I run a wait list, and I sell a certain amount of properties at one time, and then I have a wait list of people to come on. So this is one of the first times where I haven't had a back-to-back wait list before. lot of those properties which I've had on a wait list have been brought forward. They've hit the market and sold in a number of days. I touched on it slightly there, but market trends. So some of the trends we're seeing in Brisbane, and this is across all aspects of the market, there's a big shift towards auctions at the moment. Now, Queensland and Brisbane are typically auction adverse compared to our southern states. Our auction clearance rates typically hover between 20 up to maybe 35%. Usually at auctions, you would get, in the past, you may have one or two people bidding or one bidding, but you haven't had a lot of competition at auctions before. Finally, now we are seeing a lot of demand from buyers in the market, and we've got that feeling or that environment that the southern markets have held for so long now to support auctions. So you're getting multiple bidders, anywhere from 5 to 15, sometimes upwards of 20 bidders registered at an auction, and the auctions are performing quite well. So that's been a huge trend and a change in the Brisbane market up here. So for anyone that's looking to purchase, probably one of the biggest tips that I'm giving people at the moment, and that's both for investors and home buyers, is don't just think about how an owner will look at your offer on the table. Think of how your offer compares to other buyers in the market, because your main competition now is from other buyers. So you're looking at things like clean offers, building and pests, things like that. The cleaner the offer, the better the chance you have of securing a property at the moment. And a lot of people are going in with cash on conditional offers, or what you might call auction condition offers. Touching back on auctions, so the auction, I mentioned before that the auction clearance rates have risen significantly. So here in Brisbane, they're basically some of the highest levels I've ever seen, and some of historically the highest levels we've ever seen around Brisbane. So auction clearance rates now on average are hovering around the 75% clearance rate on weekends. Even on some weekends, that's risen up to the likes of 85 and 90% clearance rates. Comparing this to the same time last year, we were looking at 20 to 25% clearance rate. So you can see the difference there. It's actually a quantum shift in the take-up of auctions here in Brisbane and the competition that is there. So, when you look at that and think historically, we sort of hover around that 25 to 30% mark. Now we're seeing regularly 75% and above clearance rates. That just shows the heat and the heat that's in the market here in Brisbane at the moment. Now, one of the things I wanted to touch on here was suburbs to watch or suburbs to invest in around Brisbane. So I get to see a lot of the Brisbane market. We're based in the centre of Brisbane in Newstead, and we service all markets around that inner and outer city ring there. So some of my picks of suburbs to watch, which I think represent great buying value and also great capital growth options in the future. These are those ring suburbs. So I've seen the suburbs one in from these raise in price significantly. So you're now seeing a lot of demand moving from that inner city ring and then spilling out into these suburbs, and you're starting to see these prices rise. So on the south side of Brisbane, some of the suburbs that I'd say to watch is Yeronga. Yeronga is a great suburb there, very close to the city, surrounded by a number of hospitals, easy access in and out on public transport, easy access to the river. So Yeronga is a great area. Tarragindi, for similar reasons as well. Maruka, a little bit further out, but you get larger blocks of land there for fantastic prices, and you've got a couple of major arterial roads straight in and out of the city and out to the motorways and things like that. And then also Morningside. I see Morningside as a great opportunity suburb as well for those looking to get in and purchase either a home or a great investment opportunity there. On the north side of Brisbane, some of the suburbs that I'll touch on there, Kedron. I think Kedron is a great suburb there. It backs onto the heritage-listed Kalinga Park, which is one of the most prominent and popular big parks on the north side, and then a lot of great schools around this region as well. Wavell Heights is another great area where you've got big blocks. Some locations have city views. You've got great access, multiple shopping centres, public transport, schools. Everything's on your doorstep there. Aspley, a little bit further out, but again, a property that's getting a lot of attention at the moment as the inner city, as those inner ring suburbs start to rise in price. You're getting the overflow trickling over into Aspley now, and a lot of people looking towards that suburb. And then Mitchelton as well. Mitchelton's a great suburb there. I'm hearing a lot of buyers talking about Mitchelton. asking about Mitchelton as well. What do you have coming up? Is there anything off the market? We really want to get into this area. So that's 8 suburbs, 4 on the south, 4 on the north, that I think would make great investment opportunities. What are you looking for? I guess traditionally what I see is those investments underpinned by land typically have more demand as the years go on. So in any of those suburbs which I've just suggested there, some of the things that I would be focusing on, and what I'm seeing from savvy investors out there that are coming to me with their wish list of things that they're looking for, is houses. So people are focusing on houses. You're looking for blocks of land between 600 square metres up to 810 square metres. So don't just go for your smaller 405 or your 16 perch blocks. A little bit bigger land. If you fast forward, say 4, 5 or 10 years, that little bit larger land is going to make your property stand out amongst others. The 600 to 810s are very popular. Now, you're looking for a property that's livable and rentable between 3 to 5 bedrooms. It doesn't have to be the Taj Mahal of properties. It's just got to be something that's going to produce a good return. So that type of property is producing a good rental yield, and it's a good balance between outlay versus income. Now, with particular respect to the blocks, the properties you're looking for, definitely make sure you're looking for a flat block. It needs to be flat. If it's not a flat block, it doesn't have as high a demand both now and in the future. Flood free. Make sure you check your Brisbane City Council website. There's a flood map app on there. You can type Brisbane flood maps. You type in the address and it'll tell you whether the property is a flood property or not. So one to watch, and definitely avoid any properties which are flood properties. You're looking in those suburbs, make sure you're looking at the smaller, go down to a macro level and start to look at those streets and those areas of the suburb that are surrounded by other houses. So what you're looking for is minimal units or minimal apartment complexes. And that's what's really driving a lot of the growth in some of the inner city rings. In those properties there, they're looking for streets where they can stand on the street or look in their yard, they look around and they're not seeing any apartment complexes and things like that. So if you can find a great looking street, lots of trees on the street, nice lawns, no apartments, then that's a good sign. Now, this is a bit of a trend which is driven a little bit by COVID, but I think is going to carry further into the future, which is I think people should be placing more of a focus on school catchment zones rather than public transport, so less focus on public transport. I think if you have a look in some of the news lately, the Brisbane City Council, they're seeing a lot less utilisation of the public transport due to COVID. People are opting to drive more. We're seeing more congestion on the roads. However, that's a trend of the environment that we live in at the moment. But I'm seeing a much higher focus on school catchment zones and being closer to particular schools so the kids can walk to school and things like that. So that's a bit of a summary on what I think would make a good investment, and what I'm seeing from some of the savvy investors out there, both in the suburbs they're looking for and the type of properties they're looking at in those suburbs. So that's a bit of a market wrap from me. If there's anything that you would like to know further, anything you'd like to dive into, do a bit more of an in-depth look, then please feel free to contact me, and happy to spend as much time as you need in helping you with your particular journey.
Hello, my name's Kylie Friesen and I'm the Director at Property Solutions 101. In 2011, I created a buyer's agency. Our goal was quite simple. We wanted to save our clients money and time, minimise the stress, and offer independent advice when buying property. Today, I'm here to talk to you about the property market. I'm going to talk to you first of all about the national market, and then I'm going to bring it in. We'll talk a little bit more about the local market. First, I'm going to talk to you about the national market. CoreLogic's latest report shows that we've had a rise in property prices by 2.8% in Australia. That's been unmatched since 1988. ANZ have also done a recent report showing predictions of property prices to grow by 17% in 2021, and then it's going to slow in 2022 by 6%. So what we've seen is a high property growth, and what we'll hopefully see next year is a plateau. Let's talk about the Newcastle market. We saw a growth in March of 3.6%, which is the largest growth we've seen in the last 32 years. It was second to the largest growth in Australia of 3.7%, which was Sydney. So we're only 1.1% behind the largest growth in Australia. The Newcastle market has outgrown other regional markets by 2.8%. In the Newcastle and Lake Macquarie area, our property has grown in the last 3 months by 8.1%, and in the last 12 months, 15.5%. So we've seen enormous growth in our local region in the last 12 months. Why is the Newcastle market so hot? Well, interest rates are really low, so that always increases the interest in the market. We've got people relocating from Sydney and Melbourne. We've got low stock, and there is a massive emotional buying, fear of missing out. They are large contributing factors to why our market has grown so quickly in a short period of time. Common questions we have in this current market is, should I hold off on buying? How much should I pay for property? Where should I buy? And what is good property to buy? My answer is the same for all those questions. Do your due diligence. How much you should pay for property depends on what property you're buying, and make sure you're looking at comparisons that have sold that have the same features as the property that you're buying. What's a good property to buy? Well, let's look at this example. These two houses have recently been sold in North Lambton. They're one street apart, similar properties, 3 bedrooms, 2 bathroom, 1 car garage. The one on the right, the 840 property, had better renovation, so it was a higher quality, so it should have sold for a higher price. But what people aren't looking at is the school catchment. The school catchment holds a higher value. Lambton High School is a better high school than Jasmine High School. Therefore, the property on the right really should hold a higher premium. But because we've got people coming into our market who don't understand what due diligence is and don't know how to conduct due diligence, they're looking at them as if they're a street apart, so therefore they're similar properties. You've got to dig deeper when you're doing your due diligence and understand every feature of the property. Buying on busy roads will have an impact. Buying on train lines will have an impact in the future. At the moment, they're selling for premiums, but when the market plateaus, we'll see the biggest price drops in those products because Novocastrians don't like that product. So is now a good time to buy, or should you hold off? I believe there's still some really good value in the market. Let's look at some comparisons of properties we've recently purchased. We purchased the house on the left-hand side, which is in Lambton, 4 bedrooms, 2 car garage, 2 bathrooms. The price we paid was $915,000. That also has 3 large living areas in the property. In comparison to the property on the right-hand side on the bottom, it was 3 bedrooms, 2 car garage, 1 bathroom. It was a virtual knockdown, and they paid $1 million for that property. Is now a good time to buy? Well, if you're buying the property on the left, I believe it is a good time to buy. Let's look at this recent comparison in Mayfield. It was 3 bedrooms, 1 bathroom and 1 carport. We paid $682,500. Actually had a really nice outdoor area as well. In comparison to a 2-bedroom sale with 1 bathroom, 1 car garage, which had enormous water problems under the bathroom, it was purchased for $690,000. Is it a good time to buy? If you do your due diligence and if you're paying the right price for property, don't get involved in the emotional buying. Now, this sale this is relevant because we brought this property we settled in January. It was 3 bedrooms, 1 car garage, 2 bathrooms in Charlestown. At the time, there was a property sold for 4 bedrooms, 1 bathroom, 1 car garage. It was sold for $760,000. We purchased ours for $680,000. Recently, a property exchanged 3 streets down for $845,000. That is how much the market has grown in this short period of time. So if you do your due diligence, if you're patient, if you understand what property is worth, now is a good time to buy. But be patient. Don't get involved in all the emotional investing. In summary, it does look like we will see further growth in the property market over the coming years. Don't be disheartened. Don't fall out of the property market. Just buy smart. Do your due diligence and understand what you're buying, and make sure if the market does have a shift, the property that you're buying will be highly desired. Thank you for your time.
And finally, some takeaway points. As Ben was saying, property remains a long-term wealth creation tool. It is not an overnight success story. We need to think about the long-term compounding effect. Property remains a great diversification of assets and a return on investments, particularly in today's market compared to the return on term deposits. As Tyson was saying, plan ahead. Have your finance pre-approved to act quick. Part of the reason why the market's going through the roof is people are buying in record time, and they're buying well above reserves. As Kylie was showing us, opportunities still exist, but you've got to know the market. Due diligence is the key. And at the end, always consider your tax and loan structuring prior to your purchase. I hope you enjoyed today's presentation, found it useful. As always, any comments, send it through to our email address. Thank you. Just a reminder that this content is for education and entertainment purposes. All content in this presentation is of general comment only, which does not take into account your current personal or financial circumstances and is not advice. Please seek advice from a qualified and trusted financial advisor before acting upon any of the information in this presentation.